Hello and welcome to the Financial Fortress Guide to Attitude to Risk. Risk and reward has a relationship, and generally speaking, the more risk that you are prepared to accept, the more the returns you may see, the more of your money you could lose, and the faster it will go up and down in the meantime. When we talk about investments going up and down, we call this volatility or fluctuations, and generally, the more risk you take, the more fluctuations and volatility would be expected. With investments, there are a number of building blocks that make up the asset classes or the things that you actually buy with your money. It's more complicated than this, but to try and keep it simple, we have broken it down to essentially 4 core asset classes. The first of these is cash. Cash is the same as a bank account. It is low risk because your capital is secure, but in return for that security, the interest rate you receive is likely to be fairly low. So for emergency funds or capital you may need access to in the shorter term, cash is an ideal home, but for longer term growth, cash will unlikely keep pace with inflation. In summary, cash is safe with very likely low returns. The second asset class is fixed interest securities. Fixed interest investments are what we class as low to medium risk, and they include either loans to governments or loans to businesses. So when governments or organisations need to raise some money, they issue IOUs or take out loans, and in return they repay the capital back and an interest payment on top. The interest payment will be decided based on the security of the organisation. For example, as the UK government has an excellent track record and reputation, their interest rates will be fairly low, whereas a fledgling corporate organisation will be required to pay more. In summary, we regard fixed interest investments as low to medium risk with possibly lower returns. The third asset class is property. This is generally not residential property, but commercial, such as industrial units, factories, offices or high street retail spaces. Property values can go up and down over the longer term and does have some risks. For example, if you are unable to secure a tenant, your rental income will stop, and if you want to sell a property quickly, there may not be many willing buyers, forcing you to sell at a lower price in an emergency. In summary, we regard property as medium risk with possible medium returns. The fourth asset class is shares, also known as equities. Shares are bought via the stock market, and essentially you are buying a share of a company. You become the part owner of that company and are therefore entitled to any profits via a dividend. In addition, the share price will fluctuate depending on a number of factors. Shares are associated with the greatest level of volatility and fluctuations, and you would expect the value to go up and down every day. In summary, shares are high risk with the potential for higher returns. So let's talk about attitude to risk and how we describe it. We use 5 categories of risk to help establish people's appetite and their levels of fluctuation that they may be comfortable with. Our 5 risk categories are: number 1, cautious; number 2, moderately cautious; number 3, moderate; number 4, moderately adventurous; and number 5, adventurous. Should you not wish to take any investment risk whatsoever, you would stay entirely in cash and we would categorise you as a no-risk client. So this is not an exact science, and according to market conditions, you will probably see your investments change regularly. But to simplify the explanation, here's a quick summary of each of our risk categories. Number 1, cautious. You may broadly hold 25% in high-risk shares, perhaps 5% in medium-risk property, and 70% in low to medium-risk fixed interest investments in cash. Moderately cautious. You may invest broadly 40% in high-risk shares, 5% in medium-risk property, and 55% in low to medium-risk fixed interest investments and cash. Moderate. You may be comfortable with 60% in high-risk shares, 5% in medium-risk property, and 35% in lower to medium-risk fixed interest and cash. Moderately adventurous. Now it could be invested broadly 80% in high-risk shares, 10% in medium-risk property, and 10% in low to medium-risk fixed interest investments and cash. And finally, adventurous. This could be perhaps 90% in high risk shares, 5% in medium risk property, and 5% in low to medium risk fixed interest investments and cash. Now, before considering any investment, you should be comfortable committing your money for a longer period of time, and we will always recommend an investment term of at least 5+ years, hopefully allowing you to ride out any losses or downward fluctuations that could occur along the way. Should you wish to discuss this further with one of our advisors, you can claim your no cost and no obligation financial review by getting in touch. Remember, we are dedicated to helping every client build their very own financial fortress.